Welcome to Breaking News to Trading Moves.
You get to be here.
Today we're looking at what happens when the oil market suddenly gets, well, more supply than expected. We want to analyze the reaction, see which sectors and companies might get a boost, and which ones feel the pressure.
Right. And the backdrop to all this is, crude prices have softened.
Yeah, what are the numbers?
We saw Brent dip to $69.79 recently, and WTI, West Texas Intermediate, that fell to $65.29.
Okay.
And that movement, it's really driven by this new supply picture. It sets a kind of downward pull on price expectations, at least for now.
$65 WTI. That's definitely a change. So let's get into the why. What's causing this? You mentioned supply.
Exactly. It really comes down to two main things adding barrels back into the market.
Okay, what's the first one?
First up is the restart of oil exports coming out of Iraq's Kurdistan region.
That supply had been online for a bit, right?
It had. And now it's back. We're talking about roughly 180,000 to 190,000 barrels per day hitting the market right now.
180 to 190,000, just like that.
Just like that. And there's potential infrastructure there to push that volume maybe towards 230,000 barrels per day before too long. So it's real barrels right now.
Okay, Kurdistan exports returning. That's number one. What's number two?
Number two involves the wider group, OPEC plus 7.
Right. OPEC plus L. What are they expected to do?
Well, the latest signal suggests they're likely to add at least another 137,000 barrels per day starting in November.
Okay, so you've got Kurdistan coming back online, plus potentially more from OPEC plus OL.
Exactly. You add those together, and suddenly the market is looking at, several 100,000 barrels of extra supply each day that it maybe wasn't fully anticipating.
And more supply generally means?
Lower prices. It creates that softer outlook for crude benchmarks in the immediate term.
Okay, so that's the setup. Lower crude prices, let's follow the impact. Who wins when oil gets cheaper? Refiners seem like the obvious place to start.
Absolutely. For refiners, cheaper crude is, well, it's generally good news for their core business.
Why is that?
It's all about what's called the crack spread.
The crack spread. Remind us what that is.
Sure. Think of it as the refiner's margin. It's the difference between what they pay for crude oil, their input, and what they sell the finished products for gasoline, diesel, jet fuel, that kind of thing.
Got it. Input versus output price.
Exactly. So when crude prices fall, especially quickly, their input cost drops. Even if prices at the pump also drift down a bit, the gap, that margin, can widen.
So their profit on each barrel they process can actually increase.
Potentially, yes. It supports running their refineries at higher rates, better utilization, and it boosts their cash flow. That softer Brent and WTI is a direct catalyst for them.
Okay, so if you're tracking this, which companies are we talking about?
You'd look at names like Valero Energy, that's VLO, Marathon Petroleum, MPC, and Phillips 66, PSX. Those are key players.
Right, VLO, MPC, PSX. But hold on, if oil prices drop fast, isn't there a risk they get caught holding expensive inventory they bought yesterday?
That's a really sharp point. Yes, inventory valuation risk is definitely real for refiners. They carry large stocks.
So how does that balance out?
Well, the market reaction often suggests that the immediate benefit from that wider crack spread, that improved operating margin, tends to be seen as more impactful in the near term.
Okay.
Plus, if the price drop signals a potentially sustained lower price environment, they can replenish those inventories later at the cheaper cost. So it's often viewed as a short-term margin boost.
All right, that makes sense. So refiners benefit from turning cheaper oil into fuel. Who uses a lot of that fuel? Airlines.
Bingo. Airlines are next on the list of potential beneficiaries.
Fuel is often their biggest variable cost, right?
Yeah.
So how quickly does this help them?
Pretty quickly, potentially. Jet fuel prices track crude prices very closely. So when crude falls, jet fuel generally follows.
Yeah, and that helps their numbers out.
It directly impacts a key metric called CASM, or cost per available seat mile. Specifically, CASM excluding fuel. When the fuel part of the equation gets cheaper, their overall cost structure improves almost immediately.
CASM X fuel. Got it.
Yeah.
That gives them more breathing room financially.
Exactly. More flexibility.
But again, similar question to the refiners. Airlines hedge their fuel costs, don't they? Sometimes months or even years in advance. If they locked in fuel at $75 oil, does $65 oil today actually help them right now?
Another great point. Hedging is definitely a big part of their strategy. So yes, for the portion of fuel they've already hedged at higher prices, they won't see the immediate benefit of today's lower spot price.
So why are they considered winners then?
Because the market looks forward. Even with existing hedges, the expectation of lower fuel costs over the coming months is positive. It improves the outlook for the unhedged portion of their fuel needs, and critically, it gives them more confidence.
Confidence to do what?
Confidence to potentially offer more promotional fares, perhaps be a bit more competitive on pricing, especially head into, say, the holiday travel season. They might be able to do that without sacrificing their profitability targets, their yields.
Oh, okay, so it's about future flexibility and market perception too.
Precisely.
And the airline tickers we're watching here.
That would include Delta Airlines, DAL, United Airlines Holdings, UAL, and American Airlines Group, AALD.
DL, UAL, AAL. Okay, now you mentioned this extends beyond just transport into manufacturing, chemicals, and plastics.
Yes, absolutely. It's maybe less obvious, but the effect is there. Think about chemicals and plastics producers.
How does cheaper oil help them? Break that down for us.
Okay. For many of these companies, oil and related products like natural gas liquids are fundamental raw materials. They're feedstocks.
Feedstocks.
Yeah, the basic ingredients they use to make their products. Things like naphtha, which comes from refining crude, are used to make olefins like ethylene, which then become polyethylene, the world's most common plastic.
Okay, so oil is like the Lego bricks for plastics.
That's a good way to put it. When the price of those hydrocarbon building blocks goes down, their primary production cost decreases, sometimes quite a bit.
And just like the refiners, that means.
Wider margins, potentially. Lower input costs can expand the spread between the feedstock cost and the price they get for their finished chemical products, polyethylene, or maybe intermediates used in things like paints, adhesives, textiles, the acetyls chain.
So even if demand for, say, plastic bottles is just okay, they can still make more money per bottle.
That's the idea. It provides support for their earnings, their EBITDA, even if end market demand is a bit choppy.
And which companies represent this sector?
Key names here would be Dow, ticker DOW, LyondellBasell Industries, LYB, and Celanese, CE.
DOW, LYB, CE. Okay, we've covered the winners. Now let's flip the script. Lower oil prices aren't good news for everyone. Who gets squeezed?
Right. The most direct pressure is usually felt by the companies actually pulling the oil out of the ground. We're talking about U.S. shale exploration and production companies, the E&Ps.
The drillers in places like Texas and North Dakota.
Exactly. They are highly sensitive to the price of WTI crude. Their whole business model revolves around the price they get for the barrels they produce.
So lower WTI means?
For any production they haven't hedged, lower WTI means lower revenue, plain and simple. That flows directly down to pressure their earnings, their EBITDA, and importantly, their free cash flow, or FCF.
Okay, FCF, free cash flow. Why is that metric so critical for E&Ps?
Free cash flow is basically the cash left over after they've paid all their operating costs and capital expenditures to maintain production. It's the money they can use to pay dividends, buy back stock, pay down debt, or fund growth projects.
So less FCF means less money for shareholders or growth.
Pretty much. And when the market sees more global supply coming online, like from Kurdistan or potentially OPEC+, it anticipates lower prices ahead. That compresses the expected FCF for these companies, and often their valuations suffer as a result. Investors get nervous about their ability to sustain dividends or growth plans if prices stay low.
But again, the hedging question. Don't most of these E&Ps hedge a good chunk of their production to protect against price drops?
They do. Hedging is a crucial risk management tool for them. Many larger E&Ps might have, say, 60–70% or more of their current quarter's production hedged.
So doesn't that shield them?
It shields the current quarter's cash flow to a large extent, yes. But the market is always looking ahead. It's pricing their prospects for next quarter, next year, where hedging levels are typically much lower.
Ah, so it's the future unhedged barrels people worry about.
Exactly. And it's also about the marginal barrel. Decisions about drilling new wells are based on the expected price for future production. Lower prices also make it harder for them to add new hedges at attractive price levels. So that forward-looking uncertainty tends to weigh on their stock multiples.
Okay, that clarifies it. Which E&Ps are in focus here?
We're looking at companies like Diamondback Energy, FANG, Devon Energy, DVN, and APA Corporation, APA.
FAN, DVN, APA. Got it. And if the E&Ps are feeling pressure, that pressure must flow somewhere else.
It certainly does. It trickles down pretty directly to the oil field services and drilling companies, the OFS sector.
The companies that provide the rigs, the crews, the technology to the E&Ps.
Yeah.
How are they impacted if they don't sell the oil itself?
It comes down to capital expenditure, or CapEx, E&P spending,
Okay.
If the E&P companies, the operators, anticipate that oil prices might stay lower for a while, they tend to become more cautious with their spending plans.
They tighten their belts.
Precisely. If the economics of drilling a new well look less attractive at $65 WTI compared to, say, $75 or $80, they might decide to wait.
So they delay projects.
They might delay drilling new pads of wells, they might slow down the pace of bringing on fracking crews, maybe defer decisions on big international projects. Any pullback in E&P spending directly hits the service companies.
Fewer contracts, maybe pressure on the prices they can charge for their equipment and services?
Exactly that. Lower demand for rigs, for pressure pumping, for all sorts of equipment and personnel. It weighs down utilization rates and pricing power for the services firms.
And the major players in that OFS space.
You're thinking about the big global names. Schlumberger, SLB, Halliburton, HAL, and Baker Hughes, BKR.
SLB, HAL, BKR. Okay, one more group to discuss. The giants, the integrated oil majors.
The super majors.
Companies like ExxonMobil, Chevron, they're huge. They do everything drilling, refining, chemicals. We just said refining. And chemicals benefit from lower oil. So why are the majors listed among the losers here?
It's a fair question because they are diversified. And yes, their downstream refining and chemicals businesses do provide a partial offset. Those parts of the business benefit from cheaper feedstock, just like the pure-play refiners and chemical companies we discussed. But the scale of their upstream operations, the part that actually produces crude oil and natural gas, is still enormous. For most majors, the upstream segment is the dominant driver of their overall earnings.
So the negative impact of selling millions of barrels of oil at a lower price is just bigger than the positive impact on their refining divisions.
In the near term, generally, yes. The news flow about more supply coming from Kurdistan, potentially more from OPEC plus Lasarok, creates an immediate headwind for the perceived value of their vast upstream production. The downstream cushion helps, it buffers the blow, but the net effect on near-term earnings expectations is often negative when crude prices fall like this.
Okay, so the upstream impact outweighs the downstream benefit for now. And the big tickers there.
Of course, ExxonMobil, XOM, and Chevron CVX.
XOM, CVX. Understood. You know, looking back at this, it really highlights how interconnected this whole energy system is.
It really is.
Just a few 100,000 barrels a day of extra supply showing up, and you immediately see this potential shift in fortunes across multiple related sectors. Winners and losers emerge pretty quickly.
It does move fast, and it leads to a really practical question for anyone watching these markets. If you see these E&P companies, for example, facing immediate pressure on their cash flow and maybe their stock price because of this near-term supply news, you have to ask yourself, is this dip a temporary reaction, or does it reflect a longer-term change? Is it potentially an opportunity, assuming you believe global energy demand will stay strong over time? That's the kind of judgment call you need to make.
A key question indeed. Whether it's a short-term wobble or something more.
Exactly. And just a reminder for everyone listening, this conversation reflects analysis and opinions based on the material we reviewed today. It is not intended as financial advice.
That's right.
It's definitely not a recommendation to buy or sell any specific stock or security. Always do your own research and consult with a professional.